Heading into the last RBA meeting this week, it made sense to be short the Aussie-New Zealand dollar pair. There were three key reasons to expect Aussie weakness against the New Zealand dollar. They're outlined here. China's growth slowing. Aussie tends to rise and fall with China's economic growth. Key export commodities from Australia like iron ore, coal, copper have all been tracking lower global growth slowdown worries. And the veteran economist Saul Eslake saw the RBA as being too optimistic on the GDP projections and was expecting unemployment to rise. Now, when the RBA did meet, yes, they recognised there were some uncertainties, but they took a more optimistic view than perhaps you might otherwise have expected. So this meant that the Australian dollar has a far more neutral outlook. Now, the seasonal pattern we saw was for more Aussie-New Zealand dollar falls, and that's why it made sense to sell the Australian-New Zealand dollar heading into the RBA meeting. But now you can see price has just found a little bit of upside at the time of making this video with a fairly neutral RBA. So that means it makes sense now to close the Aussie New Zealand dollar shorts. And there's no clear fundamental reason for obvious more Aussie New Zealand dollar downside. The major trade risk is obviously, well, the Aussie New Zealand dollar could keep falling despite the more neutral approach from the RBA. Remember, HYCM clients can access the SeasonX product in order to analyse over 25,000 different currency pairs, indices, commodities, as well as individual stocks. Please do contact your account manager for a free trial to get started right away. Certain products and services mentioned herein may or may not be available to all clients, depending on which HYCM Capital Markets Group entity their trading account adheres to.